Binay Chandgothia is MD and Portfolio Manager for Principal Global Investors, and he joins us this morning right here in our Hong Kong studio. Binay, good Monday to you. So how are you this morning, considering we have the European debt crisis ongoing and what's happening in the U.S., of course?
Yeah, I mean, we had a great last few days in terms of sentiment coming back, but this week is very crucial, as also the next week, because you have the decision from EU, IMF, whether they're going to give the next tranche of money to Greece.
Yeah.
You have the Fed meeting where there is a fair bit of expectation having built up. And then, of course, you have hard economic data the week after in front of the ISM numbers, you know.
Yeah.
So that's going to be very critical.
So what's your anticipation? How are you maybe moving around assets in anticipation of what's announced?
Well, we are kind of slightly overweight equities at this point in time in our
overweight equities. Oh.
Because we really don't see much value in bonds at this point in time, you know. So we continued with overweight equities. It's hurt us a bit, but I think we are fine keeping that position.
Okay, now when you say overweight equity, some are saying you have risk on, right?
We have a little bit of risk on. We're not full up at this point in time. We're waiting for conditions to get better before we get full up.
Okay, so does that mean that you're expecting this Greek debt crisis to be solved? I mean, do you expect Greece to default at all?
We think they will ultimately manage an orderly solution to Greece.
Right.
We think they will have to agree to haircuts by bondholders ultimately, because Greece doesn't have enough in its kitty to pay everybody. That's factored in as far as the market valuations are concerned.
Especially when you see yields jump up to 80% on the two-year bond.
And not just in Greece, you know. I mean, if you look at the equity valuations, I mean, we are trading fairly cheap as compared to history. And some of that pain is already in the valuations.
Okay, so what's been priced in? You're saying an early default by Greece has been priced in. What about what's coming from the Fed then? What's being priced in there?
I think a little bit of a tweak in the balance sheet maturity, maybe a reduction in the interest rates to pay. What we would not like to see is for the Fed to expand its balance sheet further.
You mean QE3?
QE3. I mean, they can adjust the maturities on their holdings today to kind of flatten the yield curve further. But if they go out...
As an equity investor, why don't you want to see them expand their balance sheet? Doesn't that help you investing in the markets?
That's short term, you know. I mean, if you look at the equity markets after the last balance sheet expansion, it caused a big jump in prices of oil, gasoline. And that is something which is very important for the U.S. economy. At a time when consumer incomes are growing at a very slow pace, at a time when the outlook, forward-looking outlook is not so great, an additional hit by way of higher gasoline prices can be dangerous. And U.S. businesses tend to look at forward gasoline prices significantly before they decide to invest.
Of course, it affects their margins, right?
Yes, it affects the margins, it affects the entire viability program, you know.
Okay.
So we are going to be very concerned if the U.S. goes out and says, if the Fed goes out and says that, look, we are going to increase the balance sheet further by $1 trillion. We don't think that's a great outcome. It might give short-term flip to the markets, but from a medium-term perspective, it's going to push up inflation high.
Okay.
We already at like 2% on the core. We're about 3.8% on the headline number. I mean, how much higher do you want to go there? Okay,
so basically you're overweight equities. Where are you overweight? Are you buying more here in Asia than, say, what's in Europe and the U.S.? Or
Europe is definitely a kind of an underweight at this point in time. We're not too sure about what's happening there. We are regionally, we like U.S., we like, to an extent, we kind of neutral emerging Asia at this point in time.
What's that?
While we expect inflation to come off gradually over the course of the next quarter, we still need to see evidence in the form of policymakers taking their foot off the pedal. I mean, that's an expectation. That's why we are not kind of underweight on that segment. But we kind of cautiously waiting for the right time to maybe scale up the exposure.
But you're overweight on the U.S.?
Yes.
What's the thinking there, considering growth is stalled, some are saying?
Growth is down, but I mean, typically, if you look at history, if things go bad, then the U.S. tends to be better than as compared to slightly higher beta markets, you know.
Wow, in 2008, is that true?
I mean, that can easily work. I mean, you look at Europe. If you look at three broad regions, emerging markets because of pressures on inflation. Most of the emerging markets are tightening policy. Conditions are being tightened.
Okay.
Europe, they're still struggling through. U.S., probably the best place in terms of their
ability. All right, leave me with
to
this, Binay. If you're overweight on the U.S., I mean, what sectors are you looking at quickly?
Well, we kind of, from a top-down perspective, we tend to like the consumer sector on an overall basis. We tend to like telecoms, we tend to like consumer staples at this point in time. We are like okay on energy. We are not so good on materials. We're not so good on financials yet.
Okay, not just yet. Binay, thanks for dropping by. Good to see you. Hopefully we'll see you more often this year. Binay Chandgothia, Principal Global Investors, where he helps oversee about $200 billion worth in assets, joining us.